Lyn, good to have you with us here. Thank you very much for your time. The pressure that we're seeing here in India, while markets like the US, etc., do well, and I'm sort of drawing a sharp contrast because US is kind of pulling away to everyone's, not everyone's, but most people's surprise, the strength that we're seeing. For the last few years, 3 years or so, I mean, the two largest big markets which did very well were US and India. Here there is some underperformance creeping in. I mean, as I said, US is pulling away. What explains the US stock market outperformance, Lyn?
So thank you for having me. I think a big chunk of it was there's been a very fast recovery from the April time period when the full kind of tariff fears were in full effect. And so as the market kind of soothed its opinion over how it was going to turn out, there's been a pretty rapid recovery. I, for one, am pretty hesitant on U.S. markets over the next month or two until we get more clarity on tariffs. One thing I find notable currently is that the current kind of tariff proposals that are ostensibly set to go into place in August are of similar magnitude and concern as the ones back in April that were delayed and minimized in various ways. And yet this time the market's not concerned about it at all. Last time in April, credit spreads were blowing out. Obviously, the equity market was selling off. There were other signs of distress in U.S. capital markets and to some extent elsewhere. And yet this time, the market is very calm with it. And I think it's understating some of the risks going forward. I think it's overall, it's too focused on Fed activities and perhaps not focused enough on some of these tariff numbers that are likely to come in.
Lyn, hi. So, I mean, the market so far has had no reasons to be disappointed, whether it's earnings, whether it's all the tariff headlines. Do you think that the second half could be actually a lot better than what a lot of people have been forecasting up until now?
So I don't expect massive downside in the second half. I think that the strong run we've had from April until now, like mid-April until now, that I think is potentially going to run out of steam and not continue up at the same pace. Going forward, we have to see what happens with tariffs in August, and then potentially, some of them delayed into September. I think should multiple good news come in, you can certainly see the market kind of jump higher. But I think that it's already pricing in quite a bit of good news. So it's not to say that I'm particularly worried about a crash or correction or anything like that. I just think the risk reward favors some caution, perhaps over the next, 4 weeks, 6 weeks, 8 weeks, until there's more clarity. Because if you kind of map out the overall tariff proposals going forward, they're well over 500 billion, potentially over 600 billion in tariff revenues, up significantly from current months. And the market expects some of that to be negotiated down. But if markets are very smooth sailing, then President Trump has every reason to negotiate very hard or not really back down from his high tariff positions. So if the market is kind of trying to look forward through it, they could actually be giving him more ammo to keep them high.
Hi, Lyn. Good morning. Good to see you, Ben. You have mentioned in the past, I think preference could be to emerging markets in comparison to developed markets. Do you stick to that? And within the emerging markets, where does India come in at? Because we have chatted in the past, China and Brazil are relatively cheaper. India has the growth and it's more structural story. So at current reckoning, between emerging and developed, what's your view? And within emerging, where does India feature?
So I continue to like emerging markets overall. Some of my favorite areas continue to be Latin America in particular. Right now, for example, Brazil's under some optical issues because they're potentially facing 50% tariffs from the U.S. based on this latest round. The good news is out of a $2.2 trillion economy, they've got a little over 40 billion in annual exports to the U.S., many of which are agricultural products that over time could be redirected elsewhere. And it's just a very under-owned market. I think similar is true for China. India overall has not been as out of consensus as some of these other markets have been. And so I still think that there's a catch-up trade to be had with some of these more value-oriented markets. But I like emerging markets pretty broadly. I like Eastern Europe. I like Southeast Asia. I like certain parts of Latin America and China and India and elsewhere. So I do like the broader play. I don't think this dollar bear market is entirely over. I think it got overdone for a period of time. It's going through a little consolidation and a bounce, in recent weeks. But I think when we look forward another 18 months or so, I wouldn't be surprised at all to see a lower in the dollar index, which can help give emerging markets a little bit of fuel.
Okay. All right, Lyn, we'll leave it on that note for this morning. Thank you very much for joining in. You have a good Friday and, of course, a great weekend ahead. Well, with that, let's move on and talk about all the interactions that are lined up on the show today, coming up at 8:35.